Revenue receipts. Key points. Revenue receipts are receipts of the government which are non-redeemable, that is, they cannot be reclaimed from the government. They are divided into tax and non-tax revenues. Tax revenues consist of the proceeds of taxes and other duties levied by the central government. Tax revenues, an important component of revenue receipts, comprise of direct taxes which fall directly on individuals, personal income tax, and firms corporation tax, and indirect taxes like goods and service tax, duties levied on goods produced within the country, customs duties, taxes imposed on goods imported into and exported out of India. Other direct taxes like wealth tax, gift tax, and estate duty, now abolished, have never been of much significance in terms of revenue yield and have thus been referred to as paper taxes. The redistribution objective is sought to be achieved through progressive income taxation, in which the higher the income, the higher in the tax rate. Firms are taxed on a proportional basis where the tax rate is a particular proportion of profits. The non-tax revenue of the central government mainly consists of interest receipts on account of loans by the central government, dividends and profits on investments made by the government, fees and other receipts for services rendered by the government. Cash grants in aid from foreign countries and international organizations are also included. The estimates of revenue receipts take into account the effects of tax proposals made in the finance bill. Important points. Capital receipts. All those receipts of the government which create liability or reduces financial assets are termed as capital receipts. The main items of capital receipts are loans raised by the government from the public, which are called market borrowings. Borrowing by the government from the Reserve Bank and commercial banks and other financial institutions through the sale of treasury bills, loans received from foreign governments and international organizations, and recoveries of loans granted by the central government. Other items include small savings, post office savings accounts, national savings certificates, etc., provident funds, and net receipts obtained from the sale of shares in public sector undertakings, PSUs. This is referred to as PSU disinvestment.